Welcome to Clear Finance India. I am James, your personal finance guide. With the NIFTY closing out a highly volatile week just above the 23,700 mark, retail investors are facing a classic dilemma. When the market swings unpredictably, a fundamental question always surfaces. Should you invest through a systematic investment plan, or SIP, or deploy a lump sum amount all at once? Today we will explore this debate in detail to see which approach is best suited for you in today's shifting Indian market. Before we dive into the mechanics, a quick reminder. Tax implications can heavily impact your final investment returns, so please consult a qualified tax advisor regarding your specific situation. Let's start with SIPs. A systematic investment plan is a disciplined method where you invest a fixed amount of money at regular intervals into a mutual fund. By breaking your capital into smaller pieces, SIPs allow you to start small and invest systematically, which inherently helps you ride out short-term market fluctuations without panic. On the other side of the table is lump sum investing. As the name suggests, this involves deploying a larger pool of capital all at once. This approach can be highly beneficial if you have a significant windfall ready to invest and you are completely comfortable absorbing the immediate risks of market volatility. To help you decide between the two, let's break down three critical factors. First, consider market volatility. In a downward trending or choppy market, SIPs are highly effective because of a concept known as Rupee cost averaging. You automatically accumulate more fund units when prices are low. Conversely, dropping a large lump sum into a falling market can be detrimental. Historical precedents like the 2008 global financial crisis or the severe 2018 mid-cap correction in India remind us that timing a lump sum incorrectly can lead to painful, immediate drawdowns. Second, let's look at the long-term returns. Historical data demonstrates that SIPs tend to outperform lump sum investments over extended horizons, particularly across 5 years or more. For instance, looking back at a 5-year period from September 2016 to August 2021, if you had deployed a lump sum into the S&P BSE 500 index fund managed by DSP investment managers, your absolute return would have stood around 65%. However, if you had broken that capital down into a disciplined monthly SIP over those exact same 5 years, your return would have reached approximately 70%. In this environment, the SIP approach clearly beat the lump sum. Third is risk diversification. SIPs naturally diversify your entry points across time, spreading your market risk across different economic cycles. Lump sum investing carries the risk of over-concentration, especially if you deploy all your capital right before a sector or a specific market segment experiences a downturn. Now, while SIPs offer incredible behavioral guardrails, they aren't flawless. A lump sum approach can be highly rewarding if you possess a deep understanding of current macro trends and want to tactically accumulate high-growth stocks in the Nifty 50 during major market corrections. Speaking of strategic accumulation, let me share a verified insider asset allocation tip regarding gold. Many investors look to gold ETFs or sovereign gold bonds, or SGBs. If you are investing for the long haul, SGBs are fundamentally superior to gold ETFs because their maturity gains after 8 years are completely capital gains tax-free. Gold ETFs, on the other hand, attract standard capital gains tax. Keep this structural difference in mind for your long-term wealth creation pipeline. Ultimately, the choice between an SIP and a lump sum depends on your unique financial goals, risk appetite, and current liquidity. If you are systematically funding a long-term goal like retirement or a house down payment, an SIP is the most reliable wealth-building machine. But if you have cash on the sidelines and have the stomach for short-term volatility, tactical lump sum allocations can give your portfolio an aggressive edge. One practical, actionable tip you can implement today is to set up a tax-saving SIP using an equity-linked savings scheme, or ELSS, like the DSP Tax Saver Fund or the Mirae Asset Tax Saver Fund. These options provide the double benefit of an immediate tax deduction under Section 80C while building long-term equity wealth. Just ensure your investment horizon is locked in for at least 5 to 7 years to allow the compounding effect to really do its heavy lifting. That is all for today's episode of Clear Finance India. I am James. Thank you for listening. Don't forget to follow us on Spotify and YouTube, and we will see you next week. Disclaimer. This podcast is AI-generated content as defined under India's IT Amendment Rules 2026. It is for educational and informational purposes only and does not constitute formal investment advice. Securities markets are SU.